Hello friends, last week in my video we talked about how keeping tail risk hedges was the effective strategy to go forward and what a life-saving advice that turned out to be because the markets really plunged lower and it is these tail risk hedges which saved the day. Now in this video I want to discuss a very critical ratio on which the future trends of the market depends in the absolute near term. That segment is at the fag end of this video, so please do not go away. Now, let's plunge right into the regular aspects of this video. Coming up on your screen is the weekly market roundup window. It tells you that for a change, it was the banking and financial sector stocks that led the way down. The US dollar index gained 24 basis points, and that basically dragged emerging markets lower, including India. Gold and silver continued to rally. They basically saw safe haven buying coming in, and crude oil just about managed to keep its head above the water, whereas natural gas went up a little under 6% due to threats of the European Union putting in place sanctions on imports on Russian natural gas. The United States dollar versus the Indian rupee gained marginally, and that basically also exerted pressure on the Indian markets. The Indian 10-year benchmark bond yield went down by 2 basis points. That means bond prices went up. That cushioned the decline for the Bank Nifty. MWPL or market-wide position limits continued to rise, which is routine after expiry, and the US headline indices went up, and that lent tailwinds to our markets. Friends, take a look at the inset box, which basically tells you that the Bank Nifty has started underperforming the Nifty 50 all over again on a 4-week period. On a 12-week period, it's still relatively outperforming, and over a 20-week period, it is underperforming yet again. So what happens if you had invested in the Bank Nifty 20 weeks ago? Hey, you're minus. And this does not include rollover charges, execution costs, commission, taxes, etc. So over the last 5 months or so, Bank Nifty traders, rollover, buy and hold rollover traders haven't really got anywhere. And stick with me till the fag end of this video. In the special segment, I'm going to disclose a good trading outlook here. Friends, I now come to our in-house indicators, starting with market-wide position limits or MWPL. These are limits utilized by traders as a component of what is allowed by SEBI. At 39.70, you're basically at the highest level in the second week after expiry in comparable periods over in the 20-week covered by this chart. So the smart and savvy money is not yet surrendering its positions. Now that is a positive sign at this point in time, as long as the market is going up. But if an adverse and unexpected news were to hit the markets, these many large size positions will need to be reversed. That will lead to volatility. And like I've been telling you here as well as in my live mint column, that high MWPL brings with it high statistical beta or pure price volatility. Friends, take a look at the turnover in the index and stock futures segment. These are 3 concurrent series. So it's May, June, July. The turnover went up, and that basically tells you that the market decline was accompanied by trader participation, and that essentially tells you that sales are coming up in good numbers. It's not that the retail trader is getting surprised. He is also participating in the selling process. It's a mature market out here. Friends, I now come to the NSE advanced decline ratio. This is the average of all 5 trading sessions in the week. What you are seeing is that the advanced decline ratio is staying below 0 and has fallen marginally to 0.77 and as compared to the prior week 0.86. which means for every 100 losers, there are just 77 gainers. Risk appetite on an intraday basis is not good. Friends, I now come to the basis in the prompt month futures of the Nifty and the Bank Nifty. Basis is nothing but the discount or premium enjoyed by the futures over spot. Higher the basis, higher the risk appetite, and vice versa. What you are seeing is the Bank Nifty basis going up compared to the prior week, whereas the Nifty's basis has shrunk. Now, basis also erodes as time to expiry approaches. But why has the Bank Nifty basis gone up? Because at lower levels, there was short covering. And short covering increases the premium on any traded security. So, at this point in time, volatility lies with the Bank Nifty. Friends, I now come to our exclusive in-house indicator, the impetus. You won't find it anywhere else on the internet. And you've been trusting this for a little under 4 years now. Note how both the Nifty and the Bank Nifty impetus are higher, which means falls in prices in these indices were accompanied by higher momentum. Not exactly good news. So, ideally speaking, prices should rise along with rising impetus to tell you that the rally is sustainable. But here, prices are falling with rising impetus. That tells you that selling is accelerating. Now, I share this data on a daily basis on my free Telegram channel. My contact coordinates come at the fag end of this video. Do make it a point to connect with me there. Friends, I now come to our another exclusive indicator, the lift, weight, thrust, drag indicator. You won't get this anywhere else on the internet. What you saw is the Nifty registering negative performance of minus 1.87. So it fell. But the LWTD indicator rose from 0.26 in the prior week to 0.33. That tells you that at lower levels, short covering is quite a possibility. The hyperlink to a special tutorial video on how to interpret the LWTD indicator is in the comment segment below this video, as well as in the description below this video. Please do try and decipher and make sense out of what I'm talking about on the LWTD indicator. Friends, our in-house indicators done. I now come to the bond markets, which I have been tracking far ahead and far before the others, and that too ahead of equities, because this market funds other asset classes. Look at the weekly chart on your screen. It tells you that the Indian 10-year benchmark bond yield fell 2 basis points. Still at 7.12, 7.13. You're not in a zone where you would want to ladder the Indian 10-year benchmark bond yields. So I would want to ladder only above 7.60, which looks like a long shot at this point in time. But would I go in for gilt funds at this point in time? No. I would want the yields to breach the round number of 7%. Sure enough, the RBI is conducting buybacks of bonds and extremely short-term redemption period left in them. But that cannot be the sole reason on the basis of which you would go out there and start buying gilts. So at this point in time, I'm keeping the powder dry. I'm waiting and watching. I will update my plan of action on my social media accounts, especially Telegram, first, foremost, and always. Friends, I now come to the Bank Nifty, which led the way down. As you can see on the daily chart on your screen, this index has fallen on all 5 trading sessions. The price is below its month-long moving average, and the moving average itself is turning downwards. So the short-term outlook appears nervous as of now. The price is within its rising wedge formation, and the lower trend line of this wedge is more or less at approximately 46,250 level. That will be an immediate support to watch out for. Let's take a look at the weekly chart. On your screen, it shows a bearish power candle, which is also doubling up as a bearish engulfing pattern. Note how the prior week's candle was an inverted hammer, and I had also drawn your attention in last week's video to the number of hammers that have been formed in the last 6 weeks on this chart alone. The price, however, is above its medium-term moving average, so the medium-term outlook appears to be positive only for now. I continue to maintain my prior week's advice: hold the tail risk hedge strategy in place. In the description below this video, as well as in the pinned comment below this video, I have enclosed a link to a narration of what the tail risk strategy entails and how you should go about implementing it. Friends, in the week before last, this index was number 2 on the statistical beta rankings of volatility that we maintain in-house. It remained at number 2, which tells you that volatility still remains elevated. Last week, I advocated an estimated range between 50,300 on the upside and 47,550 on the downside. Unfortunately, the support of 47,550 was breached, and we saw a weekly low of 47,313 before the index recovered again. In the coming week, I estimate a range between 48,825 on the upside and 46,000 on the downside. Also watch our daily, weekly, monthly pivot levels, which I update on our free Telegram channel to help you pinpoint your trades even further. Friends, the Bank Nifty done. I now come to the Nifty 50, which has fallen 1.87% last week and registered losses on 3 out of 5 trading sessions. As you can see on the chart on your screen, the price is below its monthly moving average, which itself appears to be sliding. Note the multiple bottom support in the vicinity of 21,750 approximately. I had warned you about this level even in my media column. Now, should this level be violated, and a rough and ready head and shoulder formation in that case would be confirmed. The short-term outlook is nervous for now. Let's move to the weekly chart, which shows a bearish power candle coming as it does after rough and ready gravestone dojis in the prior week. I basically pointed out this aspect to you in last week's video itself. Also note the multiple number of hammers that this chart is displaying in the last 6 weeks. Now, this is because of the froth that is existing in the market, because it's the market is trying to discount the election results. Now, the price is poised at the medium-term moving average, which itself is appearing upwards. So, the medium-term outlook is positive as of now. A sustained breach below this level will trigger a deeper fall. On the flip side, the 22,800 is an immediate hurdle that must be overcome for the next leg of the rally to commence. Friends, in the week before last, this index was number 12 on our most volatile counters list. It jumped 3 notches to number 3. That means volatility for this index went up. Not exactly great news for traders. Last week, I estimated a range between 22,975 on the upside and 22,000 on the downside. Unfortunately, here again, my estimated low was breached, and the Nifty fell 68 points further than that to test the 21,932 levels. In the coming week, I estimate a range between 22,550 on the upside and 21,550 on the downside. Here again, please watch our daily, monthly and weekly pivot levels that I update on our social media channel. Do make it a point to connect with me there. Friends, I now come to the retail risk appetite, which is gauged by the turnover contribution of the 4 segments in the F&O space. What you are seeing on your screen is the index futures contribution level fell by 0.01%. Stock futures turnover contribution fell by 3 basis points. Index options turnover fell by 0.02%. And the stock options turnover went up by 6 basis points. So the risk appetite on the whole remained subdued. Friends, now for my own trading strategy for the coming week. First of all, My tail risk hedges that I advocated will continue to remain in place. Secondly, my trading exposure will be light because the price swings being high, even small exposure can get you bigger profits, and you need to keep the risks down. So trading light will continue. I've been posting tick by tick data in Microsoft Excel format in on our free Telegram channel on select PSUs. Now, if you've been analyzing this tick by tick data in Excel format in your own statistical trading model, you will see patterns emerging there. Our job as traders is to stay ahead of the crowd by employing quantifiable, employing mathematical or statistical tools, and the tick by tick data that I'm putting up on my Telegram channel is quite simply the best recourse you can take out there. Banks will continue to be closely monitored as well because it's all about the cost of money that is also causing waves in the market. Power generation and energy stocks too will be on my radar. I will continue to watch high MWPL or market wide position limit counters keenly because this is where emotions like greed and fear are fairly highly concentrated, and so will the trading opportunities be. I will continue to seek opportunities of theta decay in oil and gas in the commodities space. My view on bullion remains optimistic as I had specified in this video that you see on the corner of the screen. The hyperlink to that video is in the description below this video as well as in the pinned comments. Lower levels are likely to get supported in bullion by stronger hands. Now, industrial metals are witnessing divergent price action because copper is getting supported on dips, but aluminium is getting sold on rallies. I think aluminium at higher levels presents trading opportunities for savvy investors and traders. Now, this divergent view between metal prices on commodity markets can make metal companies' stock prices a lot more volatile in the week ahead. Friends, I promised you a special segment on the ratio aspect of the market, and I told you the immediate future of the market depends on this. Now, I have been telling you on multiple occasions that nothing happens in financial markets without a reason, and the reason itself is financial. And don't take anything at face value because WYSIWYG stands for what you see is what you get. WYSIWYG does not exist in the market. A lot of things which are under the radar are beyond your comprehension or line of sight, but the fact remains that they exert their pressure and pulls and pushes on the price, and therefore they are to be taken cognizance of. Now, take a look at this inset box on your screen. What do you see? You see the weightage of sectors in the Nifty itself. Now, when you see the weightage, you'll see that the single highest weightage of 34% plus is accorded to banking and financial sector stocks. Now, it is precisely because of the heavy weightage of these stocks and this sector that the bank Nifty must be boosted and the constituent stocks as well, so that even the Nifty can go up and budge higher. Note how the second and third highest weighted sectors put together combined don't even match the weightage of the banking and financial sector stocks. Which is why I told you a couple of weeks ago that before elections, which happens to be in almost 6 countries in calendar 2024, I told you the index heavyweight counters will be boosted and economic data will be massaged and a feel-good factor will be spread. Now, will this feel-good factor continue? I think you need to watch this chart of the Bank Nifty versus the Nifty 50. What do you see? This is the weekly chart. You can also toggle it to a daily time frame. What you see is that the Bank Nifty has been gaining in ratio or in relative comparative terms over the last couple of weeks. That is why you saw the Bank Nifty outperformed the Nifty 50 in the short run. Now, this is that same inset box data in graphic format. If at all you want the Nifty to go up, this ratio must also improve, which very simply means that the Bank Nifty has to go up. With 34% plus weightage in the Nifty itself, you cannot have a new bull market unless this index and its constituent stocks go up. Friends, if there are any more ideas that I need to share with you, I will connect with you on my free Telegram channel first, foremost, and always. And before I sign out of this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And in the comment segment, do please let me know what you think of my work and how I can make it even better. I request you to share my videos with like-minded traders and smart investors and traders like yourselves to help me reach out to a wider audience. Thank you for your patience in sticking around with me in this video till we meet again in my next. This is Vijay Bhambwani signing off. Do have a very, very profitable week ahead. Take care. Bye-bye.